What are the trading strategies used to build anomalies? Here are a collection of 15 articles taken from our blog, backtested on over 3,000 financial instruments and more. Let's take a look to strategy and tactic. If the strategy is the day of week and the tactic is Monday, it means that it opens the position at the opening price of Monday and close it at the closing price of the same Monday. The second example, strategy month of year, tactic 4, meaning April, or 11, meaning November, and so on. Then Halloween effect, tactic from November to April, or it can be from October to April, and so on. Instead, what is an anomaly? An anomaly is composed by 4 components: an instrument, a strategy, a tactic, and a direction. For example, S&P 500, Halloween effect, November, April, and long. Let's start with the first family of strategies called month of year, MOY and MOY multi. These strategies analyze whether and what extent the returns of an instrument are anomalous in one or more months of the year, with 2 types of strategies. First, month of year. The returns for a specific month are analyzed. The position is opened at the first trading day of the month and closed on the last trading day of the month. Instead, the MOY multi-month, for example, if it has a tactic 1-3, it opens the position on the first trading day of January and closes it on the last trading day of March. An example, the strength and weakness of US dollar between December and January against the euro. The US dollar tends to show weakness at the end of the year, then force at the beginning of the new year. Here you can see 2 charts, both from 1971 to 2020. The first is a strategy that goes short in December, and the second long in January, both on euro-US dollar. The fundamental explanation, which is important to understand why there are anomalies, is that the weakness of US dollar at the end of the year is driven by US tax legislation. For many companies, it is the day of the balance sheet. So, to save on tax expenses, in December they transfer money on foreign branch accounts, selling dollars. Then in January they buy dollars again and bring money back to the US. The second family of strategy is related to the day of week. The week is a source of temporal organization and influences the structure of our activities. There are scientific studies that analyze the change in human mood in the days of week, linking it to people's risk appetite. These strategies analyze returns of financial instruments on the days of week in various types. The first one is the trading day of week, analyzing the returns on a specific day of the week, from the opening price of Monday to the closing price of the same Monday. The second one is the trading day of the week overnight. It opens on Monday, it holds during the night, and closes it at the opening price of the next trading day. Then, trading day of the week multi. It analyzes the returns of several days of week. For example, if tactic is 1-3, it opens the position at the opening of Monday and closes it at the close of Wednesday. Multi but consecutive days of week. Here a backtest of 2 portfolios built on TDW anomalies. There are 2 lines representing the 2 portfolios. Red line built with 5 anomalies and gold line built with 9 anomalies. All TDW trading day of the week strategies on stock indices and commodities futures. The criterion for choosing these strategies, these anomalies 5 and 9, was the statistical significance of the backtest in the in-sample period, which was 1973-2010. The criterion was a rating of at least 1 star. Here you can see a card of an anomaly with a rating of 2 stars, so this anomaly is present in both portfolios. The results are that the average annual return from 1973 to 2021, the entire period, were 31%, 5 red, meaning the portfolio composed by 5 anomalies. Instead, 45% annual return for the portfolio in gold against the 8% of the S&P 500. Then we have the holidays effect, one of my favorite. Interesting periods to be studied are the days before and after an holiday, such as Christmas, New Year, and so on. Generally, in literature, economists state that the days preceding the holidays are generally associated with positive mood, which determines a greater propensity to risk, so more shares and fewer bonds. Instead, the days following an holidays are generally associated with a negative mood of people, and therefore with a greater aversion to risk. Less stocks, more bonds. On forecast cycles, there are three types of strategies aiming to catch this holidays effect. The first one is HOL B, meaning before. It analyzes the returns in the days before the holiday. Then we have after, A, analyzes the returns in the days following the holidays. And finally, HOL C, across, analyzes the returns in the days before and after the holidays. Here an example on S&P 500. In the table there is the average return in the in-sample and out of sample period, gross and net mean without trading costs, after trading costs, of the main 11 US holidays, analyzed with the HOL C33 strategy on S&P 500, meaning that it buys 3 days before the holiday and sell 3 trading days after the holiday on closing price. Let's keep in mind that in the entire period, 1928 to 2021, S&P 500 had an average gross yield, gross return in 6 days of 0.16%. Let's take a look of the table. The first column is the holiday table. This is all, meaning all holidays together. Then we have New Year, Washington birthday, Memorial Day, and so on. Then we have the number of trades, 93 New Years, because there are 93 years. The years when out of the sample period start, 1999 and so on. Then we have a block of gross returns and the net average returns. Both average, gross average return, net average return. And here we have 3 columns. The first one in sample, out of sample, the central one, and then HOL, the last one, both for gross and net. We can see that each holiday has a positive average gross return, while 3 of them have a negative average net return. This is the column. You can see every row is green, meaning that each holiday has a positive gross return. The 3 most bullish holidays throughout the period were in order: New Year, 1.4% here, Independence Day, 1%, Christmas, 0.92%. This is a perfect example of anomalies, because remember that the average gross yield in S&P 500 in 6 days was 0.16%. These trading strategies hold the position 6 days, so it is the same amount of period, same 6 days. But 1.4% is 8.7 times higher than expected. 1% of Independence Day was 6.2 times higher than the average. And finally, Christmas, 5.7 times greater than average.